Okay, firstly, a couple of info links on the SoFiE Seminar Series. The main one being the web link at the top. It has the future seminars coming up and links to all the videos that we've recorded in the past. And then a couple of announcements this time. First of all, today is the last day to submit your paper to the SoFiE annual conference. It's February 22. I've submitted my paper already. And if you haven't done it today, then today is the day to do it. That conference is in mid-June in San Diego, and perhaps with some virtual elements. And then the next announcement is a related seminar series that's just been launched. It's Artificial Intelligence and Big Data in Finance. It's going to be held the last Thursday of every month, and the first seminar in that series is this Thursday. And the organizers, I should say, are down the bottom of the slide here. The first seminar is this Thursday, and that's Stefan Nagel is the speaker, and Kent Daniel is the discussant. And finally, last announcement, the SoFiE Machine Learning Virtual Conference. The program for that is now up at the website, which is listed here on the slide. That conference is a one-day conference on March 5. Okay, a lot of advertisements today. Now, let me welcome everybody to today's SoFiE Seminar. I'm Andrew Patton, the organizer of the series. Today, I'm very happy to be hosting Caio Almeida from Princeton University as our speaker, and his discussant will be Torben Andersen from Northwestern. We'll use the same format as in the past, 40 minutes for the speaker, 10 for the discussant, and 10 for Q&A at the end. If you have questions, you can use the Q&A box at the bottom of your Zoom screen, or you can use the raise your hand feature and I'll call on you to ask the question. I think that's it for the admin. So now I'll turn it over to you, Caio, and if you can share your screen, take it away.
Perfect. Thank you very much, Andrew, for having me here. Thank you. I would like to thank also the committee for choosing our paper to be presented. This is joint work with Gustavo Freire from FGV, a former PhD student who's in the market now. And we're going to talk about pricing of index options in incomplete markets. So let me see. So the paper is motivated by this important question in empirical option pricing, which is how can we reconcile, or if it's possible to reconcile option prices, a cross-section of option prices with underlying asset returns on the physical distribution, or like a time series of underlying asset returns. So this has been analyzed in many different venues by different researchers. And it is a challenging question because in general, not always, there are some exceptions, but in general, to reconcile this risk-neutral distribution implied by option prices with the physical distribution of underlying returns, you have to take a stand on like investor's preference. You have to somehow like make some assumptions on investors' preferences, and then there was like a first set of researchers that has worked under the assumption of market completeness and try to reconcile these two data sets. And in general, in most of the cases, they found puzzling results. For instance, like the non-monotonicity of the pricing kernel whenever they were extracting information from options and underlying returns. And I cite just like a few of these papers. There are many more papers, and there are also like recent papers that are able to reconcile this data without the pricing kernel puzzle. For instance, a paper by Nicola and Giovanni Baronadesi and co-authors, like that is just published in Journal of Econometrics. And but in general, like this were the kind of results that were found. Some puzzling results due to like imposing this completeness or dynamic completeness of markets. And another possible venue is to consider that markets are incomplete. And there's been like a large literature also working in this direction. And for us, it makes sense to consider markets are incomplete because, you know, like we see so large trading volumes of options in general, in particular of index options, that suggest that they are non-redundant. On the top of that, we clearly see that the stochastic volatility and jumps both on the underlying and the volatility are well-established empirical stylized facts now that like are compatible with market incompleteness, right? So in a situation like that, you can imagine that if we impose minimal economic restrictions, let's say absence of arbitrage, or if you're going after absence of arbitrage, you can invoke this first and second theorems of fundamental theorems of finance or asset pricing, and you identify that the existence of an infinity of risk-neutral measures, or like a well-behaved, or like I would say at least like non-negative pricing kernels. And so we're going to follow this path of the literature. And what has been done there? what has been done by the previous literature that accepts or like suggests that markets are incomplete. They identify a set of pricing kernels or risk neutral measures that price the underlying asset and let's say a risk-free bond. And from this set, they propose option price bounds. Like there is a set instead of like one measure, which kind of like in contrast to the previous literature. And they give this bounds for option prices, but these bounds, they don't tell you how to really reconcile a specific measure, risk neutral measure with the one specific option. Let's say one option in this cross-section of options that we are analyzing, which risk neutral measure gives the price. You see if the price lies within the bound or not, but you can't see the measures because those bounds are abstractly calculated from this set by solving some minimization problems, where you are basically restricting the whole family of no arbitrage pricing kernels by saying, for instance, like imposing an exogenous restriction on the variance of the pricing kernel, like Cochran-Sarrequero, or like on the gain-loss ratio, which is another loss function, like Bernard and Ledois, or you're doing like something also very interesting, which is to limit this family to only the pricing kernels that are compatible with risk-averse investors, like second-order stochastic dominance, like Richcan and Constantinides, Jackworth, and Perakis. And then you select like a smaller family, but it's still too large to be able to say something about specific measures within the family. So what we do in this paper, we follow this literature, but we try to identify, to make a compromise, to identify a smaller set of risk neutral measures, but that allow us to somehow, that we are going to parameterize this set by a certain parameter, gamma, that soon you're going to see what it is. It parameterizes each of the loss functions that we use to identify this, what we call minimum dispersion risk neutral measures. And then the beauty of it is that for each of these measures, first, you select this family of measures, which is still infinite, but it's smaller than the whole family of no arbitrage. But it is parameterized by this parameter gamma that is going to tell you, give you information about what are the risk preferences of investors that would, be marginal investors using that measure to potentially price an option. And since we identify a monotonicity between the prices of any options, calls or puts, as a function of this gamma parameter, then you can invert the gamma parameter like it's done with implied volatility in Black-Scholes. And then you can identify one unique measure that is pricing that option. And at the same time, you can extract some economic information about what would be the marginal investor that will be pricing that option via this gamma parameter that I'm going to try to tell you that is related to prudence, like absolute prudence, as we're going to see, mostly related to absolute prudence. It tells something about risk aversion, but it doesn't, like all the measures within this family, they are like related to risk averse investors. So that's not what really distinguish them, but in terms of prudence, this gamma I think is going to make a difference which gamma you're choosing. So what we do is first we establish this monotonicity between option prices and the gamma that determine each of these risk neutral measures in the set, and then given that we extract this implied gamma parameter that allows us to identify this marginal investors information about this marginal investor pricing each specific option that we're analyzing in your cross section. And the gamma gives information also about option relative expensiveness, because we're going to see that since it is the option price is a monotonous function of gamma, if you have a different gammas in the cross section, you can extract an implied gamma. And if there is an implied gamma smile, that's going to tell you something about the relative expensiveness of options, exactly like the implied volatility tells you, but in a model that is not specified like Black-Scholes, because Black-Scholes tells you that there is a unique log normal measure that should price all the assets. So if you are distorting the implied volatility, you're saying that you need different log normal measures with different volatility to price a cross-section of options. While if you have an implied gamma, you're just going to be saying that potentially there is some heterogeneity in investors or some market segmentation for this cross-section of options in pricing these options. But these investors are going to have different characteristics and be able to price the options. And we're going to also be able to say something about which options are more or less expensive in terms of their moneyness. Okay, so that's what is done in this paper. And then empirically, we analyze data from S&P 500 options, almost 2 million prices. And we basically extract this implied gamma patterns and analyze cross-sectionally in the time series what we can say about this those implied gamma patterns. So that's what's done in the paper. So the outline that I have here is just like there are two parts for the talk. First, like a theoretical part where I define the methodology. I explain how we obtain this minimum dispersion risk neutral measures, and from the measures how we obtain the option price bounds, and given the bounds and the measures, how we identify this marginal measure that prices a given option whose price, of course, lies within the bound. If there is an option, observed price, that is not within our bounds, we can't say anything about that option. We can just say that it's not compatible with being priced by this specific class of risk-averse investors that we choose to give the bounds for these options prices. Okay, and in the second part, we have this analysis for the S&P 500 option market, where we're gonna basically provide option price bounds, see how many of these options we are, what's the percent of the options we are able to reconcile with the underlying return distribution, physical return distribution, and also to analyze the implied gamma patterns. Good. So let me tell you a little bit about the methodology here. So as I told you before, if we are starting from the assumption of an incomplete market, and what is an incomplete market for us here is a very simple incomplete market, right? So it's very, very important to make it clear. It's just a one-period model. So the market is going to be incomplete in any case where you have the number of states of nature larger than the number of basis assets. In the paper, we have some analysis for a certain finite number of basis assets that doesn't need to be only the underlying, but we are concentrating on the underlying case because that's the case that allows us to analyze this potential market segmentation, option market segmentation, and also that makes all the investors or pseudo investors in this family that we're going to analyze solving the same utility problem, just changing the utility, but not the basis assets. They're all solving a maximization problem where they have to choose between a bond and the underlying asset, stock underlying, which in our case is going to be the index. So incompleteness for us is a larger number of states of nature than assets. In this case, we are concentrating on the underlying asset as a basis asset. So in any situation where you observe a time series of underlying asset returns, which is bigger than 2, it's an incomplete market. So if it's an incomplete market, you have potentially an infinity of risk neutral measures that we call admissible risk neutral measures that are going to price this underlying asset excess return with respect to a risk-free rate. So we are analyzing, since we are identifying risk neutral measures, we don't have to worry about, for instance, the mean of an SDF. So we just calculate the excess return of the underlying and price it in the Euler equation that we want to price. And then we select all, there's an infinity of measures that are going to be able to price this underlying asset time series of returns. But in population, what do you do? What you basically want to find a risk neutral measure from this infinity of risk neutral measures that price the underlying asset that's the closest possible to the empirical physical measure, which is also, you can also discuss how to identify this measure, but the simplest possible way would just be if you observe a time series with capital T observations of returns, is just giving the empirical probability 1/t to each of these returns. And then we want to calculate what is the distance between a risk neutral measure and this physical measure, such that the risk neutral measure will correct the physical measure to price the underlying asset. And the distance is measured by a loss function. And we choose a family of sensible loss functions, which is given by equation 1, which is the Kress and Reed family of discrepancies, which has been used a lot in econometrics, by researchers analyzing generalized empirical likelihood estimators or generalized minimum contrast estimators, depending on if you are looking from the primal space or dual space. And the same in finance, I've used this family with René for the 15 years now, and many other researchers, including Lars Hansen, is using this family now, in problems in finance and economics. And this is an interesting family because it captures many loss functions at particular cases. For instance, the quadratic minimum variance problem defined by Hansen Jagannathan in the 91 paper for stochastic discount factors, or Kubeck labor information criteria that's been used by Stutzer and others, minimizing the entropy. and empirical likelihood, many others like are within this family, and that's the family that we chose. And what is interesting is that you can parameterize it by one unique parameter gamma that is going to be telling what is the sensitivity of your optimization problem, and you're minimizing the distance between the physical and risk neutral distribution, the sensitivity that this Radon-Nikodym derivative is going to have with respect to higher moments of the risk neutral measure. This problem can be solved in a dual space. I'm going to show you soon. And gamma can also be interpreted as like a parameter that gives you the sensitivity of the risk neutral measure with respect to higher moments of the excess returns of the underlying asset. So in this way, you can really like choose measures that have different sensitivity or exposure to skewness and kurtosis of the underlying asset return. So how do we solve this problem? We solve it in a sample version. So we define excess returns by observing a time series of the underlying asset returns. And we use the empirical probabilities 1/t for the physical probability measure. And then we solve problem 2, which is just a sample version of problem 1 for each member in that Cressy-Reed family that's indexed by this gamma. So we minimize this loss function where like the pi q is just like risk neutral measure, and how we see that it's a risk neutral measure. It prices the excess return of the underlying asset. It is a probability because the weights sum to 1, and it's bigger or equal to 0 because we need it to be on the closure of the set, because to solve this optimization problem, the set should be a closed set. So that means that you have to also look at solutions on the closure, which would allow for some zeros there, exactly like other people have done in the literature. So that's not exactly like a traditional, strictly positive risk neutral measure, but it is still absolutely continuous with respect to P. And it's important to have it because some solutions for the problem, in particular, the Hansen-Jagannathan solution usually is on the closure of the set, can have some zeros for some states of nature. Okay. So that's the problem that we solve. And then René and I used some results from like convex duality by Bourgeois and Lewis to show that you can solve this problem by looking at this dual equation here, given by equation 3, where you maximize, you find the lambdas that maximize this function, which has the flavor of a Hara utility. So that's like a Hara utility. It's a particular case of a Hara that we're defining here as to being like a concentrated version of a Hara, because a Hara is more general than that. It has some other parameters here, like instead of 1, you can have like a constant here and another constant here. But what is beautiful is that the Hara, like the family, as I told you before, like we choose it because it's like it's an interesting family that captures many loss functions used before. But if you look at this dual problem on the top of that, you can see that that Cressy-Reed family finds this family of Hara functions, which is the largest family of utility functions that are time separable utility functions, such that you can time separable expected utility functions, that you can express all the pricing information, all the relevant price information is expressed by the score of the function that only depends on one parameter, which is the gamma. You can get rid of all the other parameters of the Hara, including the initial wealth, and they're going to have the same implications for pricing the underlying asset and options. So that's very good for us because we can, in the end, use this gamma parameter, and invert the gamma parameter to say something about the marginal measure that's going to price each of these options in the cross-section. So that's why that's one additional advantage of using this family. So if we solve this optimization problem, like the first order condition of the optimization problem gives us the minimum dispersion with neutral measures that are going to be a hyperbolic function of the underlying excess returns, indexed by this gamma, as I was telling you, that gives you some sensitivity with respect to skewness and kurtosis or higher moments of this excess returns. So we showed that in the paper. And what is interesting is that actually this gamma is going to give us some information about the risk preferences of this pseudo agent that will be solving this optimization, this utility problem when pricing the option, like the marginal investor that would be identified using this risk neutral measure to price one specific option later in the presentation. So what does it tell us? All the gammas for all members in this family, they have a positive absolute risk aversion. They are within the family of risk averse investors, like all the higher investors. But what is interesting is that there is this concept of absolute prudence, which is defined by the minus the third derivative of the utility divided by the second derivative. And it's in general related to precautionary savings in dynamic models. Okay, so we're gonna see like how much the individuals save like because of uncertainty. So we don't have any dynamics here, it's a one period model, but you can also associate prudence to aversion to downside risk, which for us is very appropriate and interesting here. So individuals that have positive prudence are more averse to downside risk, to extreme events. And in our family, all the individuals that have gamma, all the risk neutral measures that are identified by gamma smaller than 1 have a positive prudence. So that means that those marginal investors would be prudent and worried about extreme negative events in their lives, while investors with a positive gamma bigger than 1 are non-prudent. They are not worried about extreme events. And finally, like the gamma equal to 1 is exactly the Hansen-Jagannathan minimum variance problem, but translated to a risk neutral measure, which is equivalent to a stochastic sum factor. And in this case, the prudence is equal to 0. So that's the splitting point of the family. But with that, we can observe like potentially what is, if there is very like a cross-section of different heterogeneity in terms of prudence when pricing the different options with different moneyness for a fixed maturity. And that's what we do later in the paper. Okay, so let me show you a little bit how these risk neutral measures work. So here we have 1 million returns that are like sampled from a log normal distribution. So the empirical probability, the physical probability measure is just like 1 over t, 1 over 1 million, like and it's given by these dots, like the black dots here. And then we start solving for some of the risk neutral measures that price the excess returns or the underlying asset that came simulated from this log normal distribution, just as an illustration. So this is the minimum variance measure. So it's linear on the excess return. So you see that since all the measures are compatible with risk-averse investors, what they're going to be doing? They're going to be taking mass from the physical distribution, like taking mass from positive excess returns and distributing it to negative excess returns because investors are risk-averse. They put like higher weight to negative returns in general. The question is like how much relatively higher or lower weight in the extreme returns these investors are going to put as a function of gamma. Okay, so that's what I want to tell you, which is related to the prudence I described in the previous slide. So if you have investors that are non-prudent, like they have like a gamma's positive bigger than 1, they're going to generate concave risk neutral measures. Okay, so those measures they're going to put relatively to the guy that is neutral to prudence, like the linear risk neutral measure. They're going to put less weight on extreme events, both negative and positive. Of course, all these measures are going to be still stealing mass from the physical distribution, like positive returns and sending to negative returns, but in a relatively different way. All the investors with a positive gamma bigger than 1, they are non-prudent. They're not worried about what's happening in the extremes. They actually are worried about what's happening in intermediary returns. So you see that they have a larger mass. There are 1 million points here, many of them concentrated here, okay? So that they're putting much more mass in the intermediate area of returns around 0, excess returns around 0, okay? And also you can also see that the way I was telling you before, that those measures are on the closure of the set. They have some zeros for very positive returns. Instead of, I mean, they want to put very low weights, they can't go to negative weights, the solution gives you zeros. Okay, that's what happens on the right-hand side of the family. On the other hand, on the left-hand side of the family, then you have prudent investors, like with positive prudence. They are worried about downside risk in any situation for extreme returns. So they start putting more and more weight to extreme returns, like getting to even situations like that, for instance, gamma equal to -2. So these measures are highly convex, the investors are prudent, and they're gonna give larger prices to options than the investors which are non-prudent. You can see that options are convex payoffs that in general depend on one of the two extremes of the distribution, right? Like let's consider, like for instance, an out of the money put is gonna be very concerned about this region for excess returns, negative excess returns. And you see that like those convex measures, they put much more weight to the events, the probability events in this region than the concave measures. So the prices of options are going to be larger, of these out-of-the-money puts are going to be larger for very negative gammas. So actually the prices of all options, puts or calls, they are monotonically decreasing with the gamma because the convexity of the measures is decreasing with the gamma. Okay, so we use that to invert the gamma, and we use that to compare the prices of the different options. Okay, so given this explanation about the minimum dispersion measures, what we do, we select from the whole set of risk neutral measures, just those measures. It's a compromise. It's a small set compared, for instance, to second order stochastic dominance, small in this like abstract sense, but we show later in the empirical exercise that it gets bounds which are very close to the second order stochastic dominance bounds, but we can identify the measures. So here we start working with this set of risk neutral measures. We're analyzing the paper, and we try to characterize as much as possible this set. So the first thing that we show there is that there are no solutions for gamma going to in the limit to minus infinity and plus infinity. So we showed that in the paper. And then like the solutions are going to be confined to finite minimum gamma and maximum gamma. Then we also show in the paper that this set is connect. So you can't really have like separate intervals, you know, like with risk neutral measures, then you stop having a measure, then you have like a new measures or a point with holes. So it's going to be an interval of measures. So that we show in the paper. And then like after that, we have an algorithm there describing how you can identify the whole set of measures, this whole interval by like with a search. So in the end, you are able to obtain this interval. And then given that like you know, we show endogenously how to obtain this set, because of course it's going to depend on the observed physical distribution of the underlying returns, right? So that's the way we define the admissible risk neutral measures that price these underlying returns. But given the set, we can show how to calculate the option price bounds actually. So I'll give you an example here with the option characteristics. So you have, suppose you have a European call option with a capital T days to maturity and a certain strike price X, okay, and a certain observed price C. So we use first the characteristics of the options to come up with the bound. We're not using the price, of course. And how do we do that? We just use like risk neutral valuation, like in any other problem we would use. Like the option price is going to be the conditional expected value of the option payoff using the physical underlying returns, RT, that we observed, like for instance, the time series. You know, like the payoff discounted by the risk-free rate. So given a certain risk-free rate, and the underlying observed underlying asset returns, physical underlying asset returns, we are able to calculate the option prices for any member in this interval of minimum risk, dispersion risk neutral measures. But in particular, since we show that this option price is a monotonic function of the gamma, to determine the option price bounds, you can just concentrate directly on the minimum gamma measure and the maximum gamma measure. The minimum gamma measure is the most convex measure, the one that has gamma underlying. And that's going to give you the highest option price. And the maximum gamma, gamma bar here, is the most concave risk neutral measure. So that's going to give you the minimum option price. So that's the only catch that you have to be always inverting, like with respect to the gamma. But then you can just calculate these two prices, and then you get the option price bound directly. If you want to look what are the prices within the interval, of course, you can walk around the gammas, but you don't need to calculate the bound. And then later you just get the option price that you observe, for instance, C, and you verify if it's within the bound or not. If it is within the bound, we can recover the unique implied gamma by inverting the gamma exactly like we do with implied volatility. If it's not on the bound, we say we can't reconcile this option with our family of loss functions or Hara investors. Okay, so how does it work with an example here? Suppose we have an option. I just get an at-the-money call option with 1 month to maturity, and then we simulated like underlying asset returns again to show this picture here, and we also calculated the true option price. But first we identify from the underlying asset returns what are the gamma minimum and gamma maximum, right? After that, you could directly obtain the option price bounds, but here for illustration we just use the grid of gammas, and we calculated the option prices using our implied risk neutral measures, like the ones from minimum dispersion. So this is the price for this particular option. So you see that it is decreasing with gamma. It's not linear. It's like non-linear up to a certain region, then it can approximate it linearly. And also you can see that there is a different sensitivity for negative gammas and positive gammas. So it's less sensible for positive gamma. So if you look between -1 and 1, you see the price varies much less between 0 and 1 than 0 and -1. So yeah, that's a feature of the family, because those concave measures on the right-hand side start having more and more zeros. So it takes longer for them to, react, while the convex measures are much more, they're more sensible. Okay, after that, you can just calculate the prices, like the minimum price and the maximum price. As I told you, the maximum price comes from this gamma equal to -3.2 measure. It's given here. And the minimum or the lower bound for this prices comes from the maximum gamma. And after that, you observe the true option price, which was close to 2.05. You can invert the implied gamma, and you see, oh, this implied gamma is negative, -0.8 is compatible with an investor who is prudent, has aversion to downside risk. That's the way it works. So just in summarizing it, we ask in the first step if we can reconcile the options with underlying returns, and we identify the set of risk neutral measures, and we calculate the option price bound, and we identify if the option price is within the bound or not, and then we say if we can reconcile or not. And the second step is, how do you reconcile? If the option is within the bound, you can identify the implied gamma. You're going to talk about risk preferences, in particular prudence of the investors that are consistent with this option price. And once you have this implied gamma for a cross section of options, you can analyze if there is some segmentation in the market in terms of this prudence when pricing the options, and or some heterogeneity in this cross section. And you can also try to ask if this implied gamma pattern gives you the same kind of information that an implied volatility pattern will give in terms of option relative expensiveness or not. So basically, those are the two questions. If there is heterogeneity, potential yes or no, and if there is, what is the cost of these options in respect to the others, relatively speaking. Okay, so given all that, let me jump to the empirical exercise. So we have this almost 2 million option prices between 86 and 2019. We have two different option data sets, one from 86 to 95, which is Berkeley's option database, and the other one is Optionmetrics from 96 to 2019. And we split the options in different moneyness categories and also maturity categories. This first category is since it's S divided by the strike, you see that this is the category for out of the money calls in the money puts. Okay, the middle one is for at the money options. And the other category is the one that we want to look more in this presentation, out of the money puts in the money calls. We don't eliminate the in the money options. We use the usual filters, in terms of liquidity. We know that they are less liquid, and that appears on the bounds because we can't reconcile as much with the in the money as we can with the out of the money options. So in general, for most of the dates, the option data presents the well-known volatility smirk that comes from after the crash. Okay, so what we do for each day, we estimate the conditional physical distribution non-parametrically for S&P, and that's where we can discuss a lot, and I'm not going to spend time here, but of course this is very hard to do, right? And there are many different ways of doing that, so I'm not going to spend much time here. What I can say here, and we can discuss later in the informal session, guys, in case you guys are interested, is that if you have a less precise estimative of this physical distribution, of course your bounds deteriorate, and you can say less about the implied gamma patterns because you have less options within the bounds. For the kind of things that we used here, we were able to reconcile around 95% of the options because we used some forward-looking measure for volatility, okay? That somehow use an at the money option discounting a risk premium. But there are different ways of doing that depending on how you're identifying this conditionality of the distribution. You can deteriorate your bounds. Okay, but we use 3-month treasury bill as risk-free rate, and we calculate the bounds using this conditional non-parametric distribution that we identify. And then once we have the bounds, we can look at all the options that are within the bound and extract the implied gamma. So let me show you what happens on a typical day on our sample and on a crisis day. So the first line is for a typical day, the second line for a crisis day. So What is that? This is like just like for one fixed maturity, 60 days. Okay, kind of like a short maturity, not as short as Torben uses like a weekly options, but 60 days. Those are the observed prices for calls and puts for 60-day maturities. Like in the stars are puts and the circles are calls, all in implied volatility, which is easier to analyze than in prices. Okay, so all in implied volatility. The solid lines are our bounds. Okay, that's the upper bound and the lower bound. So you see that all these options that vary only on their moneyness here in the horizontal axis, since like they all have the 60-day maturity, they fall within the bounds. So then we can invert the implied gamma for all of them, and that's the picture that we have on the right-hand side here. And then what can we see? We can see that, for instance, like for out of the money puts up to at the money puts, you know, like I'm concentrating on puts, but the calls is the same thing. They kind of have like a prudent guy pricing them, so a similar guy up to very moneyness, very close to, let's say 1.02 or something like that. So it's a prudent guy, a similar guy. And then for out of the money calls, you have a non-prudent guy with very large gammas. Okay, so that's the idea. And we could say also that the out of the money calls or in the money puts are less expensive than the out of the money puts, which is the kind of same like skew pattern that we observe with implied volatility. You have to be careful here because there is more, as I told you, like there is much more sensitivity on the left side of the family, on the negative gammas, right-hand side here, than on like a positive gammas. But you still, on the big picture, you can say like when something is more or less expensive because there is this monotonicity of the prices with respect to gamma. Okay, so that's one thing that we can get from here. So there is some heterogeneity, or let's say like a segmentation in terms of like who prices out of the money calls with respect to who prices out of the money puts. And if you go to a typical day during the crisis, like we got in 2008 here, so you see that the bound, the prices are still within our bound, but you see that here, they are almost touching the upper bound. That means that we are not very good in identifying the conditional variance here. The conditional volatility of the physical underlying returns was low for us. We had it low because that's what gives you the level of the bound, okay? So I didn't have time to discuss much that here, but in terms of like the moments of the physical distribution, the mean gives you how the width of the bound, okay? The mean, like the equity premium. Like if you have a very large equity premium, the bounds are gonna be larger, okay? So it's like that. The variance gives you the level of the bound. So if you are very bad identifying the variance, you're gonna be off. And the higher moments of the physical distribution give you the slope, which we are doing in general a pretty good job with this family in identifying the slope to see that the slope of the bound is similar to the slope of this volatilities mark observed in data. But what I want to call your attention to is this like a right-hand side picture here, where you see that you can reconcile all these investors, all these options, I'm sorry, with a kind of a similar investors, not perfectly dissimilar, but like a prudent investor with the gamma around like -4 here, you know, like for most of these options. And that's something that you observe dynamically later, that during crisis, the guys that price the out of the money calls or in the money puts, they become more prudent and kind of like you decrease the segmentation, which is kind of like a reasonable thing to imagine, you know, like, but you can't see that with implied volatility, but you see that they kind of become similar to one guy pricing all these options during the crisis. That's one of the results that we obtained with implied gamma. So I see that I don't have more than 2 minutes. Is that right, Andrew?
Yeah, maybe 3 minutes.
3 minutes.
Okay. Started a couple of minutes late. So yeah, three or four.
Perfect. So now, like after I showed that picture, which I think is very important, like here's the table with like how much we can reconcile of these options, and you see that we can reconcile much. I mean, like more than 96% of much of the different options for different like moneyness and maturities and calls and puts, with the only like observation that for short in the money options, both calls and puts, like this is the worst result. They are less liquid in general, so you get 89% of the puts and 94% of the calls, still like a very reasonable, but using that idea of like a forward-looking volatility for the non-parametric physical distribution of returns. Okay, so that's what we get. And like in terms of like the average implied gammas for these different categories, like for the different maturities on the columns and different moneyness on the lines, you see that what is interesting to observe is that the third line gives you the out of the money puts in the money calls. They are all priced for the different maturities, calls and puts with prudent investors, negative gammas. And the opposite, like the out of the money calls in the money puts, are priced with non-prudent investors on average. So that's what I have to observe here. There are more things to say, but in the interest of time, I want to move. And because those pictures are highly complex and I want to tell you a little bit about them. So this one is like the implied gamma over time. So the first line is the implied gamma. The second line is the implied volatility, the traditional implied volatility. Let's concentrate on the second column here for only puts. This is short-term puts in our category, so puts that have maturities between 20 and 90 days. And we're calculating the 2-month moving average of all the implied gammas in that category here, okay? For the different, of course, like moneyness, in the money, at the money, out of the money. So you can see from this picture here, like the bottom picture on the second column, that's the implied volatility, that there is the usual smirk. The out of the money puts, which are in blue, are more expensive than the at the money and in the money puts, okay? And you observe that along the whole series. And during the crisis, the implied volatility shoots up, but doesn't invert, right? There's no inversion here. So it's always like the implied volatility smirk. As for the implied gamma patterns, you see the same thing, but inverted now, since we know that negative gammas give higher prices. So out of the money puts, they have in general prudent investors with convex risk neutral measures pricing them, negative gammas. So they are more expensive than at the money puts, than also like in the money puts. But what I wanted to call your attention for is like that during the crisis, this guy that was pricing in the money puts, short maturity, it comes closer to the others and they all become like a prudent investor, which was similar to what I showed you in the cross section. So kind of like this heterogeneity decreases, not because the prudent guys that price out of the money put change, but because the other guys that are pricing out of the money calls or in the money puts, they move closer to the prudent guys that price out of the money puts. Okay, that's one thing. The other thing is like that the implied vol is compatible with the misspecified Black-Scholes model, while here this different like implied gammas are compatible with heterogeneous investors in these incomplete markets. That's the main difference. Okay, and in the next picture it's the same idea, but now for the crash. Okay, let's look again at the second column. What I wanted to call your attention to is about the skew patterns and relative expensiveness. The implied volatility, which is in this bottom picture here, was almost flat before the crash, which is this dashed line here, okay? Because investors imagined that like they could trade like as if returns were log normal, but they were not log normal. Actually, the physical distribution was highly negatively skewed and leptokurtic, okay? But they were not taking that into account. So the implied volatility was flat. Then the crash hit, and there is the usual implied smirk pattern with out of the money puts being more expensive than the others. While if you look at our patterns here, you see that the out of the money puts, which are in blue, they were cheap. Why? Because these investors were not observing like or relating any of their calculations to the physical distribution. The physical distribution said there is a chance of like a negative extreme event. They're not taking that into account. So they were pricing, the price was low. How can we reconcile the price with our family? We need a highly positive gamma, a convex distribution, risk neutral distribution that puts less mass on the negative events. After the crash, then everything inverts again, and you get the usual smirk. So in this sense, like there is some information here, even with all the problems of identifying the physical distribution, that could tell you some story about option expensiveness that you couldn't tell just observing the risk neutral information that comes from implied volatility. Okay. And then like the last thing I want to tell, if Andrew allows me, is that we did like things that are not in the version of the paper that Torben read, but we calculated some left tail gamma and right tail gamma, and the same for implied volatility, which is basically averaging the gamma for all options that are that have like moneyness bigger than 1 or smaller than 1 to kind of represent like out of the money puts versus out of the money calls, like so the left tail would be related to out of the money puts and like the right tail out of the money calls. And then we run regressions of market returns like for different horizons here that are represented in the horizontal axis on these measures. And you see that the left tail has some like significant t-stats, the right tail doesn't. And there is also like some significant adjusted R-square for this market return predictability from like this out of the money puts like implied gammas. And the implied vol has no significance at all, as shown by Tim and Token and Zhu in their like 2009 paper on variance risk premium. So we imagine that this gamma is somehow like capturing, of course, it's capturing this prudence, which might be related to some aversion to, it is related to aversion to downside risk, and like consequently probably related to some measure of jumps, like in returns. And that's it. I think I don't have more time, right? So just concluding, this is a new method to try to reconcile option prices and underlying asset returns. And the main novelty is that we really can identify each marginal measure that prices these options. And with that, we can say something about like the different potential investors that are pricing this cross-section of options, and see if you know, this parameter that we call implied gamma can give you some information in terms of like the investor's preferences, option relative expensiveness, and if it can somehow be related to other important measures in the literature, for instance, the market predictability, variance risk premium, and so on, that are things that I'm still working on. So thanks a lot. And
okay, thank you, Caio.
Yes, I'm stop
Right.
sharing.
We'll turn it over to Torben.
Okay, thank you, Andrew. Do you see my screen?
Yes.
Yes.
That is good. So thank you for letting me opine on this interesting paper. Let me say that it doesn't have a ton of econometrics, but it has a lot of computational theory related to options. So in that sense, it's falls within the things that are very interesting to me. But for those of you who want to see financial econometrics with emphasis on econometrics, there's not really standard errors and stuff like this, but you know, it comes from that branch of the literature that tries to rationalize option pricing more generally. So let me, without further ado, just jump into it. So Caio and Gustavo's paper tries to develop a new method to reconcile option prices from relative to the underlying objective returns. By objective returns, I mean the usual things that come from the P distribution. And let me, you know, it relates to a bunch of literatures, but I think I will probably run short of time. So let me not discuss those literatures, but it relates to this literature where people extract the state price density or pricing kernel or stochastic discount factor from options and underlying returns. Okay, so here's the basic approach. So I'll just review quite briefly the theoretical approach, and then I will discuss much more the empirical bite or the empirical implications of this. To me, it's mostly interesting if it helps us understand the empirical phenomenon that we see in the index option markets. So that's going to be the focus, right? So here's the basic approach. They want to select a risk-neutral density to price basis assets first. So they want to get a sense of what is this Q distribution. And as Caio said, they focus on where you're just extracting the risk-neutral density or pricing kernel from the underlying asset, in this case, a one-dimensional thing, namely the equity index returns. So think of the S&P 500. And we have the usual asset pricing, no arbitrage condition here, that the current value of the asset should be equal to the, to the discounted value of the expected future price at some horizon cap t. And my EQ operator here is basically representing the stochastic discount factor or pricing kernel. Now, for computational reasons, they discretize this. So imagine there are n different states that the future price can take. And we index them by st of I goes from 1 to n. So we have these n states and just one asset. So I'm going to talk a little bit more about how they generate these potential states that you see in the future. But, you know, at this stage, there's not much of an assumption. You can just have an enormous amount of states. So you can kind of make a large grid from a very low future price up to a very high future price. And those are the attainable states. And the task is then to assign risk-neutral probabilities to each of those. And that when you then discount this expectation, which represent this, at the risk-free rate, we get the current price. So think of this as these are given, we need to extract these pi IQs, okay? And this cap T is chosen it can be any horizon, in principle, future horizon, but think of it as being chosen as guided by the available on a given day, the available tenors that we have for the options. So different times to maturity, there are like 3 or 4 or 5 available maturities we're interested in. So we choose that particular horizon to do this exercise for. Okay, so how do we find this state price density, this set of probabilities here to satisfy this equation in a reasonable way? Well, there are n of these. There's just one price over here. So in general, there's going to be an infinite or a very, very large number of solutions. How the heck do we choose between those? There will be an infinite number of solutions. Well, let's think naturally in the no arbitrage setting, we would have equivalence, and we would have that all states that are possible should have a possible probability in terms of the pricing as well. You know, Caio explained why they allow sometimes to have some 0 states, but you know, I'm not going to ponder that. So basically, they're going to pick this the Q's to satisfy this basic arbitrage relationship down here, the pricing equation, fundamental pricing equation with these restrictions. And again, there's an infinite number of solutions. So how do we choose among them? Well, let's minimize the distortion that we have to do from the physical measure to get to the risk neutral measure. And that's where it relates to a lot of recent literature that has proposed to use minimum dispersion type procedures and classes of families to choose a risk neutral density given a physical density. So again, I'll talk a little bit more about how they come up with this physical density, but it actually is now important that they're going to take as given not only the future states that we can see for the underlying, but also at that horizon, what probabilities under the physical measure do we have to assign to each of those. Okay, so you have these pi i's. And then the problem becomes to minimize the mapping, the distortion or twisting we do, or the physical probability measure to get to the risk neutral one. And I'm not going to talk much about this Cressy-Reed divergence family, but it's indexed by this gamma, and Caio talked about it in some length. But what it does is it minimizes this objective function here, and as special cases, we get a lot of the things that have been discussed in the literature that I have run into. I've recently been discussing papers by Paul Schneider and Oleg Bondarenko, who both chose entropy for their way of doing this. Well, you can find other people emphasizing the Hellinger distortion measure. You can find Kullback-Leibler, even the mean squared error or quadratic kind of loss functions or divergence measures here. They are all special cases for some particular value of gamma. So in that sense, it's somewhat broad. Now they solve this because it's a difficult problem to solve by looking at the dual, which happens to turn into be a one period that is from time little t to the horizon cap t. You can think of that as optimizing a one period Hara utility, a special version of the Hara utility function. And that for different gammas actually includes utility functions you've seen before as linear, log linear, constant relative risk aversion, exponential, quadratic, and so on. So basically, when we settle on a gamma, we can interpret the pricing that's taking place as the marginal utility investor has this particular gamma within this family of Hara functions. They also show using this approach, which is much more tractable than the direct minimization problem on the previous page, that it allows you to determine a closed interval of gammas, gamma on lower bar and upper bar, the closed interval that's finite, to that those are the bounds that are combated. That's where the pricing will have to be. That's the gammas that are admissible to give us the pricing. And so observe that this interval, this bounded interval is fixed. It's specific for a given time t. So it changes day by day, and it changes by the option horizon that you're looking at, or the forecast horizon you're looking at. So you extract one each day for each maturity. You have a different set of gammas implied by the underlying distribution. Okay, so now all of this has been done without actually looking at the options. So it's simply using this base asset, in this case the S&P 500, and getting this insight that we want to look at these pricing kernels indexed by gammas. So now you can go and say, okay, let's take a call option on day T with maturity cap T that has the jth strike price, so KJ, and you can look at the payoff on that call option, which is here. You can weigh it, probability weigh it according to your extracted gamma that you're choosing within this family. So for each of these gammas in here, you could price this option and get a different price. And it's according to the standard no arbitrage value. And what we're going to say is that we can then, the insight is you can then vary gamma within these bounds, and you'll get a continuous set of values for the call option that would rationalize what we're seeing, meaning these are the bounds that we can explain or can rationalize with this Hera class utility function or this divergence measure for that given option. So this is specific to this option at that maturity on that day. But what we can say is if the market price falls in this set, these bounds that we have, then we have reconciled in some sense that option price with an underlying kind of utility framework on underlying minimum dispersion twist of according to this family, right? So basically the option price is consistent with the underlying returns using a standard state price density. You can also, if the price actually lies in this interval here, you can then vary the gamma and you will actually find one gamma that exactly prices it because you get continuously moving, as you move gamma, you move continuously in this space. So if it lies in here, there'll be exactly one gamma that will price it exactly. So you get this implied gamma that varies across the options, like Black-Scholes implied volatility varies across the options. And you can interpret this gamma in some sense relative to at the money implied gamma that prices the at the money option exactly. And you can kind of see G is the gamma larger and smaller, and you get the interpretations that Caio talked about. Okay, so that's all I wanted to say about the theory for now. Let me contrast this to what we usually do when we take reduced form models and no arbitrage approaches to pricing options, right? What the parallel to what these guys do, Caio and Gustavo do, is that usually you would look for something you can think of as one unique gamma, but generally speaking, we have a multi-dimensional parameter vector, and we hope using representation of the risk neutral density or the risk pricing or the stochastic discount factor, we hope to price all options at day T, at all maturities, at all tenors, and across all the strikes. So that's the usual game we are playing, right? We want to find a pricing kernel that jointly can price all of them on a given day. And in fact, in most times, we also want to price it consistently, at least over a limited period of time, of weeks or months. We don't want the pricing kernel as such to vary too much. Their approach, of course, is a bit different. You get this gamma cross-sectional variation, typically across the strikes and across the tenors, that is interpreted as segmentation, meaning it's okay to have one guy with different preferences pricing the in the money call options versus the in the money put options and vice versa. So they are allowing these guys to have different utility functions, so there be a different marginal investor at for each option on each day across each tenor. So it's a little bit like thinking about, I'm going to allow the risk aversion that I'm using to price things to be different for each option. And I'm going to see if I can rationalize it by identifying a different marginal investor for each option price. And then it's a different game. And I want you to be more talkative about that in the paper. You know, it really comes to a head in your simulation when you take a stochastic volatility coincident jump model as the underlying true model, and you have a P and Q distribution for that. And then you can find the gamma option prices for that, and you get a skew of some type. And that gamma skew you interpret as, okay, there's a different marginal investor pricing each of the options, but it's generated from a model that where we are really, in some sense, having no arbitrage solution. We have well-defined risk premiums So there is a marginal representative investor here that's marginally pricing everything correctly. I can't tell you what the utility function looks like for that guy, but there is a pricing kernel here, and you are representing it as a bunch of heterogeneous pricing kernels or prices across all of the options. So, what are the better approaches? You have the advantage you can interpret these prices here in utility terms or in deviations from P to Q terms. Over here, I can think about risk premiums from different empirically observed things like jump risk and volatility risk, but I have a harder time writing down what utility function it corresponds to. I can't explicitly write down the pricing kernel, that's kind of hard. Okay.
I'm sorry to interrupt, Torben, just to let you know, maybe two more minutes.
Okay, so I got to get to the empirical stuff. So let me even jump past this comment that I have here. Okay, so you generate the P distribution. I thought that's pretty clever, and you underplayed that a little bit in the way you did it. You use these historically backward-looking return to get a histogram of thousands of realizations, but then you calibrate the volatility of the realizations going forward by using the implied volatility at the money and a risk premium adjustment according to the SVCJ model. So that's actually not bad. You could check this assumption. I think that's actually very important. If you want to empirically use this, you need a credible representation on the underlying P distribution, because you're using those pi i's relative to the pi I q's. So what are the assumptions you're invoking here? It is that if you devolatize that return distribution appropriately and all days in the past, you should recover this scale invariance. Things should look scale invariant. So there's a way you can test whether what you're assuming about the P distribution makes good sense or not. And I would encourage you to do that. My main comment on the empirical side is that, my goodness, you are using way too restrictive a moneyness assumption. This 0.90 to 1.1 for all tenors, for all volatility levels, gives you an enormous variation in the sense at which you're looking at the relevant options empirically. I'm trying to illustrate this here. This is taken from, I think there's a couple of graphs from our paper in the JF with Nicola and Victor, where we look at weekly options and monthly options. These are the monthly options, and you could see options are traded way out of the money here on the downside. These are the lock prices. And so this is the pricing of options. This is the out of money call options and put options. The bound you're using for monthly options is about here. So you're not really looking at this tail part at all. That's where a lot of the interesting action happens. You can see from here to here, another day, the tail is much fatter here, but you're only looking at things that happen in this range here. If I calibrate what the 10% in and out of the money is from a 1% daily volatility. If you're looking at annualized options, so you're looking at maturity split close to 360 days, you're only looking at a span that's this much. So as volatility increases, you are looking at a smaller and smaller range. It's no surprise that you get homogeneous pricing of things here. But what's really challenging, if you want to say something about the out of money put options, is this range out here. You are never looking at it, and you are particularly not looking at it high volatility and long maturity days. You are looking at this very, very narrow range of options. So in order to say something about the pricing or tail risk out of the deep out of the money put options, you need to be much wider in this. Here is just an illustration of what you get with weekly options. And you have basically very well defined, even in 98, for short dated options, kind of indication of where the option pricing is. Nowadays, you would see there are hundreds of options with 7 days to maturity. So I really would encourage you, because there's so much interesting action, and a lot of the asset pricing implications, I think, comes from variations in this tail here, where people express their discomfort with very large negative returns. And so I think you're going to struggle dealing with that with the range you're looking at. Another quick observations, if I have time, is this point that you are mapping everything into kind of a one-dimensional object, the gamma, when we do the reduced form models, we find we have to have 2 or 3 different types of risk premium: diffusive risk premium for volatility, and then the tail, the jump risk things. There are kind of 2 effects going on. I think it's going to be very difficult to map the pricing of volatility risk and tail risk jointly into one-dimensional thing. It's a little bit why when people extract things with a standard pricing kernel, they get these non-linear or non-monotonic pricing kernels happening. It's because you don't get the stochastic volatility along with the downside risk pricing jointly. So I think you should confront that, and it shows up a little bit in your simulations with the SVCJ model. I think that's more or less it. I had one more comment, and that is, I think the reason why you restrict yourself to a certain sample, which I think is not in terms of the moneyness, is you refer to a paper from 1996. Maybe at that point that was indicative of the type of options that were liquidly traded. The things have changed a lot since then, and you would gain much more empirical insight by looking at a much wider strike range and a wider set of tenors or times to maturity. Thank you.
Okay, thanks very much, Torben. You were making too many good points. I thought I'd let you run late, but we are a little bit late. So Caio, if you have a very brief thing you'd like to say in response, and then I think we'll do questions in the post-seminar.
I just want to thank Torben for the amazing comments. Like, I have things to say, but not now. In the interest of time, it was better to have him giving all the comments, and then we can discuss later. So thank you.
Okay, well, thanks very much. Well, given we are a little late, I think I'm hoping we've got tons of questions, but let's do all those in the post-seminar hangout session. So maybe
let me just say that I enjoyed reading the paper, and the theory is intriguing. The empirical side, I think there's a lot more you could look at and do. But I'd love to discuss here, so hang on and we will talk.
Yeah, good, let's stick around. Torben, if you would mind stopping to share your screen.
Shall do. Oh, it shows up here. So.
There we go, thank you. All right, well, please stick around. But before we leave, let me do a brief advertisement for the next SoFiE seminar. The next SoFiE seminar is in 2 weeks' time. On March 8, we'll have Seth Pruitt from Arizona State University as the speaker, and his discussant will be Jenny Bai from Georgetown. So I hope to see you all in a couple of weeks' time at that seminar. And now we'll end the official seminar.